The offer letter says $120,000. You read it 4 times. Not because you don't believe it. Because you want to make sure there's nothing you missed. No clause, no condition, no catch. There isn't. The number is real. The address is real. The firm is real. You fold the letter once, put it in your desk drawer, and go to sleep at 11 p.m. You will not sleep at 11 p.m. again for the next 3 years. Level 1, Analyst, $120,000, $150,000. You are 22 years old. The desk is smaller than the one in the interview room. That's the first thing you notice. The second thing is that no one looks up when you walk in. 14 people in the bullpen. 14 screens. No eye contact. You find your seat, you log in, and you wait for someone to tell you what to do. Nobody comes. At 9:07 a.m. your manager, a man named David who is 29 and speaks in short bursts, sends you a 47-tab Excel model and types, find the error. There are 6 errors. It takes you 4 hours and 11 minutes to find them. You send them back. He replies with one word, good. That is the last compliment you receive for 4 months. The work is this, you model. Every day. 14 hours minimum. Sometimes 16. The models are for companies, earnings projections, debt schedules, DCF valuations, sensitivity tables. You build them and you rebuild them, and when the numbers shift you rebuild them again. There is a 40-page industry primer due every Monday morning. There is a weekly sector update due Thursday at 6 a.m. There is always something due. You are not thinking about money yet. At week 3, you make your first mistake. A revenue figure in tab 12 is hard-coded instead of linked. The model propagates the error forward. David catches it at 11:45 p.m. on a Wednesday. He does not shout. He sends you a screenshot with the cell circled in red. Fix it. You fix it in 23 minutes. You send it back at 12:08 a.m. You do not sleep until 2. You think this was an exceptional night. It was not. It was Tuesday. There is a senior analyst 1 row over. His name is Marcus. He is 26. He has been here 4 years. He does not complain, does not explain himself, and does not eat lunch at his desk. Every day at 12:15 he disappears for 35 minutes. You watch this for 2 weeks before you understand. He is protecting a piece of his day. Just one piece. Everything else belongs to the firm. One night in month 4 you are alone at 1 a.m. finishing a model. Marcus is still there. You are about to close a tab you don't need. He walks past your desk and stops. Don't close that. You look at him. That's the error tab. You'll want it tomorrow. He walks away. That is the only thing Marcus ever says to you about the work. You keep the tab open. The next morning you need it. The tab you want to close is usually the one you need most. By month 7 you are building models from scratch in under 3 hours. By month 10, David stops checking your work line by line. By month 14, you are checking other analysts' work. You are being shaped. You do not feel it. You just keep building. At the end of year 2, the firm promotes 3 analysts to associate. 9 were eligible. You are one of the 3. David calls you into the conference room. He says comp moves to 200. He says nothing else. The meeting is 4 minutes. You walk back to your desk. You do not smile until you are in the elevator. Level 2, associate. You are 24 years old. The desk is the same desk. The building is the same building. The hours are the same hours. But something has shifted in how people look at you. Not much, just enough to notice. You now attend portfolio manager meetings. Not to speak, to listen, to carry the deck, to answer if a number is questioned and to be invisible if a number is not. For the first 6 months as associate, your job is to be correct and quiet. Those 2 things in that order. The portfolio manager is a man named Vincent. He is 41. He manages $2.3 billion. He speaks during meetings exactly as much as necessary and not one word more. When he disagrees with a pitch, he does not say he disagrees. He asks one question. Just one. And the question is always the right question. The one that exposes the assumption no one wanted to examine. You study how he does this. You begin writing the question down after every meeting. In month 4 as associate, you sit in a Monday morning meeting and a junior PM is presenting a long position in a European telecom. The pitch takes 22 minutes. The slide deck has 34 pages. The projections are clean. The narrative is tight. Vincent listens with both hands flat on the table. When the junior PM finishes, Vincent asks, "What's the churn assumption?" The junior PM hesitates for 1.9 seconds. You count it. 3%. Industry average? Also 3%, specifically for their legacy customer base? Silence. The meeting ends. The position is not approved. You pull the company's last 3 annual reports that afternoon. The legacy customer churn is 6.1%. No one in the pitch had looked. The right question is always about the assumption everyone agreed not to examine. As associate, you begin running your own screens. You are looking for long ideas, companies undervalued by at least 30% with a catalyst within 18 months in sectors you have been assigned. You generate 14 screens in year 1 as associate. 11 are rejected in the first meeting. 2 are tabled. 1, a mid-cap industrial in the Midwest, makes it to the investment committee. It is approved. The position generates $4.1 million for the fund over the next 11 months. Your name is not on the trade ticket. It never is at this level. The recognition comes differently. At your Year 2 associate review, Vincent includes one line in your written evaluation. Shows investment instinct. Needs discipline. You read that line 9 times. In your 3rd year as associate, your base moves to $300,000. Your bonus, performance dependent, brings total comp to $380,000. You spend $52,000 on rent, $14,000 on taxes above what was withheld. You save more in this year than your parents earned combined in any year of your childhood. You do not talk about this. Not at family dinners. Not with old college friends who are 3 years into teaching or social work or mid-sized consulting firms. The number creates a distance that no one names. You begin to understand. You are not in the normal world anymore. You stepped out of it when you accepted the offer letter, and every year since, the gap has widened. You are 27. You are paid $380,000. You have never made a trade you owned entirely. That is about to change. $400,000 is the floor now. You are 28 years old. You own a sector, technology hardware, 17 companies, $340 billion in combined market cap. Your job is to know more about these 17 companies than anyone at this fund and more than most people at any fund. Not slightly more, comprehensively more. You cover earnings calls the day they happen. You read every 10K, you build and maintain a master model that tracks all 17 companies on a rolling basis. You have 3 primary sources at each company. Not management, never management. And you speak to them on a cycle every 4 to 6 weeks. You do not tell them what you're looking for. You ask open questions and you listen for the gap between what they say and what they choose not to say. This is the level where most careers stall. Not because of incompetence. Because of ownership without authority. You own the sector, but you do not run the capital. The position sizes are still Vincent's. The final call is still Vincent's. You can recommend with conviction and be overridden in 30 seconds. You can be right and still watch a position get cut because portfolio level exposure doesn't allow for it. The best analysts at this level learn to decouple their ego from the outcome. Most cannot. In your first year as sector lead, you build a thesis on a semiconductor company, 4 months of work, 214 pages of analysis, 3 channel checks, 2 site visits. Your target price is $74. The stock is trading at $51. You present to the investment committee in March. Vincent approves a $22 million position. The stock hits $47 by June. The position is down $8.8 million. You do not flinch publicly. You recheck every assumption. 11 of 14 are intact. The thesis is intact. The pressure is external. A product delay, a supply chain issue, publicly disclosed and temporary. You go back to Vincent in August with a 1-page update. Thesis intact. Catalyst delayed by 2 quarters. Recommend hold. Vincent looks at the page for 12 seconds. Hold. The stock closes at $79 the following February. The position exits at a gain of $49.3 million. Vincent says nothing to you. That evening, he CCs you on an email to the managing partners. The semiconductor position closed today. Full credit to your name. That is the only time your name appears in a managing partner email for the next 2 years. You are 30. You are paid $620,000. You are right more often than you are wrong. And you are beginning to understand that being right is necessary but not sufficient. There is a woman in your building named Sandra. She is 44. She is a sector lead who has been at this level for 9 years. She covers consumer discretionary. She is one of the best analysts you have ever met. Precise, patient, with a 7-year track record that most PMS would trade their tenure for. She has never been promoted to PM. You ask her once why she stayed. She looks at you for a moment. Because I know what I'm good at. She pauses. The people who get promoted to PM are not always the best analysts. They are the people willing to carry the P&O alone. She returns to her screen. Knowing what you're good at is wisdom. Knowing what you're willing to carry is different. Level 4. Portfolio Manager. $1 million. You are 33 years old. The number is real. You check the wire transfer twice the same way you checked the offer letter 11 years ago. But the number is not the thing you think about most on your first morning as portfolio manager. You think about the P&L. You have been given $180 million to manage. A sleeve within the fund, 14 positions. Your own book. Your name on the door in the only way that matters. The way that shows up in the weekly attribution report. The first thing you do is nothing. For 6 days, you do not make a trade. You read every position. You model every thesis. You speak to every analyst who covers these companies. You build a view. On day 7, you cut 3 positions that were legacy holds, inherited from the previous manager, and redeploy $31 million into 2 new ideas you have been developing for 14 months. The head of risk management, a man named Franklin, calls you into his office on day 8. You moved fast. You tell him I moved with conviction. There's a difference. Franklin looks at you for a moment. He nods once. He will say that same phrase back to you 18 months later in a different context. The P&L at the end of your first quarter. Up 4.1%. The fund benchmark. Up 2.3%. You do not celebrate. The second quarter you are down 1.9%. The benchmark is flat. The drawdown on your book hits $3.4 million in a single week in October. You sit with it. You check every position. You do not panic. We do not cut. You hold the 2 new positions and add $4 million to one in week 3 of the drawdown. By December, the book is up 7.2% for the year. The benchmark is up 3.8%. Vincent calls you. The call lasts 7 minutes. He says, "Good year." He says, "What did you learn?" You tell him, "I learned that the drawdown is the test, not the return." Vincent says nothing for 3 seconds. "Good." He hangs up. You are 35 now. Your book has grown from $180 million to $290 million. Your carry, a percentage of profit above the hurdle rate, has begun to compound. Total compensation for the year, $3.2 million. 3 years ago, $3.2 million would have seemed impossible. Now it seems like the beginning. You no longer check the wire transfer twice. You do not think about what the number means in terms of what you can buy or own or spend. You think about it in terms of what it costs you if you are wrong. That shift, from receiving to risking, is the most fundamental change that happens to you at this level. And no one explains it before it happens. The drawdown is the test, not the return. Level 5. Partner/managing partner. $10 million. You are 41 years old. The number is not a salary. It is not a bonus. It is carry. Your percentage of the profits above the fund's hurdle rate, multiplied across $4.2 billion in assets under management. You did not write a check for it. You earned it by surviving levels that removed nearly everyone who started when you did. Of the 14 analysts who joined in your year, 3 made it to associate. 1 made it to senior analyst. You are the only one who made it to partner. This is the level where the work changes in nature, not just in scale. You no longer run a book alone. You run capital allocators. You have 4 portfolio managers reporting to you. You set the risk parameters. You approve or reject position sizes above $50 million. You review attribution weekly. You are in every investment committee meeting, not as the analyst with the deck, not as the PM defending the thesis, but as the person who decides. The conversations at this level are different. You are no longer discussing whether a stock is cheap. You are discussing whether the fund structure is right, whether the fee model is sustainable, whether the next generation of talent is being developed or merely managed, whether the edge that built this fund, the systematic deep research approach that Vincent built 18 years ago, is still the right edge in a market that has changed in ways Vincent did not anticipate. Vincent retired 2 years ago. He is 63. He lives in Connecticut. You speak once a month. He never asks about specific positions. He asks about one thing every call, the same thing every time. Is the culture still right? You tell him yes, you mean it, but you know what he is asking beneath the question. He is asking whether the thing he built has survived the people who inherited it. Whether the edge is structural or personal. You do not have a final answer. You are building one. You think about Marcus, who told you not to close the tab. You have not thought about Marcus in 11 years. He left finance at 34, a personal decision he said in the email, and now runs a 40-person consultancy in Denver. You think about Vincent's question about churn. The right question is always about the assumption everyone agreed not to examine. You use this in every investment committee meeting. You have never told anyone where it came from. You think about Sandra, who stayed at sector lead for 9 years because she knew what she was good at. Sandra is still at the fund. She is 56. She is the best analyst in the building. She will retire as a sector lead on her terms, and she will have been right about herself the entire time. You think about Franklin, who said you moved fast on day 8 of your PM tenure. Franklin runs risk for 3 funds now. He said your phrase back to you 18 months later when you were defending a position that was down 11% in a week, and you told the investment committee, "We moved with conviction, not speed." Franklin smiled. You had forgotten you said it. You are 41. The fund manages $4.2 billion. Your carry last year, $14.7 million. The year before, $9.1 million. The year before that, $3.2 million. The compounding is real. Not theoretical. Real. But the number you carry most is not a dollar figure. It is the 14 analysts who joined in your year. One partner. Not because the other 13 were inferior. Not because they weren't smart or disciplined or capable. Because this work at the highest level asks for something that sits beyond intelligence and beyond discipline. It asks for a specific kind of endurance. The kind that does not require external validation. The kind that can sit with a $3.4 million drawdown in a single week and feel the weight of it without collapsing under it. Some people have it. Most don't know if they do until they're already in the chair. You sit in the chair now. The offer letter is in a drawer somewhere. You have not looked at it in 17 years. The number on it was $120,000. The map was always there. Most people just couldn't read it until it was too late to matter.